I'm going to go ahead and start recording. For the record, this is a class on optimal trade entry, fibs, and order blocks. All right, so let's go ahead and get started. The first thing that we want to talk about, let's go ahead and list it out here. So the first thing is OTE, right? This is a term coined by ICT. This is not mine. This is something that he coined, and all credit goes to him. So who can tell me what OTE is? Who can tell me what that is? Who can tell me what that stands for?
Trade entry.
Optimum entry?
Perfect. I see a couple answers in the chat. I also heard a couple answers. If you guys want to answer, please make sure you guys are answering in the chat, so we can keep the actual airway a little bit clear. So yeah, this actually means optimal trade entry, right? So it's optimal trade entry. Now, what does this mean? What does this mean? What is the optimal trade entry? Firstly, let's go over what this is and how actually ICT coined this. So the optimal trade entry is a part of the Fib tool, okay? And the Fib tool is something that a lot of people use, but they don't exactly know how to use it. So let's go over how to use the Fib first. So if you guys are writing down notes, make sure that you guys note that this is a Fib tool, or the Fibonacci tool, right? So this is a Fib tool. However, this also falls into one of our categories that we have in the bootcamp. If you guys have watched the bootcamp, that is called the range finding tools, or the range finders. For all of you bootcamp veterans, who can tell me what a range finder tool is? Who can tell me what a range finding tool is? So the Fib, right? The Fib is one of them, to try and estimate where price is going to go. Right. So let's think about this in, so it's a tool that helps you find optimal trade entries, a PD array. Perfect. So I see a lot of good answers, a lot of answers that have a little bit of synchronicity with each other. Let's go ahead and actually, let me tell you what a range finding tool is. So a range finding tool or a range finder in real life, right? In real life, this is something that a sniper uses to actually call their shots, right? To measure wind direction, to measure a bunch of things that they need to actually call their shots. And usually somebody else is doing that for them. However, in the Forex world, right? In the Forex world, what we call a range finding tool is, and I want you guys to write this down. So a range finder is a tool which gives you an area of interest, or an AOI, right? This can also be point of interest, which is point of interest, which is also known as POI. A lot of times you'll hear us say POI, right? And the POI is kind of like a zone, right? So for example, let's say that that you're looking at a trade and you want to know exactly where a trade will go in the future. Well, in this case, you're going to use this range finding tool to actually help you find the zone in which you can go down on lower time frames. And if you guys remember the first rule of trading, price is fractal. Who can tell me really quickly, what do I mean when I say that price is fractal? For all of you guys who are new. Who can tell me really quickly, what is price is fractal? Repeats itself on all time frames. Perfect. Lower time frames, bigger time frames, it's all the same thing. They all follow the same set of rules. They all follow the same positioning, right? And they all follow the same sort of sequence, right? So if you see an order block on lower time frames, you can safely call it an order block, or at least the zone in which you will get a reaction, because of the fact that price is fractal, right? And because of that nature of price, we're going to allow ourselves to use this tool on both lower time frames and on higher time frames. Mustafa yesterday in class was talking about order blocks and how he usually uses them. And a lot of times, personally, what he does is what I've seen him do is he uses the actual optimal trade entry, which I'm going to give you the settings for here in a second. Um, he uses that to help him find areas of interest, and then within that area of interest, he allows himself to actually analyze that trade. So this is a range finding tool, right? OTE is a range finding tool. So now that we have that out of the way, let's go ahead and actually go into what the actual OTE is, okay? And let me go back to a chart. So let's go to a clean chart here. Very quickly, who can tell me how to use the fib? Because I know some people are a little bit newer, and I want to be a little bit more accommodating to them. So I'm gonna ask you guys to just bear along with me and make sure that you guys are being considerate of your newcomers. So, swing high to swing low or vice versa. Swing high to swing low or vice versa. Perfect. So essentially, right, the fib tool, what it ends up doing is a lot of times you'll go from a swing high to a swing low, depending if you took liquidity. That's just kind of my kind of criteria, right? So in this case, let's talk about NZD/JPY, which we took last night, and let's talk about why we actually took profit, right? So let's see from where it started to where it began. So where's the swing high? This up here becomes the swing high. This up here becomes the swing high. So we can note this as the swing high, right? We can note this as the swing high. Let's ignore Grammarly there. This is the swing high, right? Now, where's the swing low? The swing low would be right here. The swing low is this whole area, right? We can consider this whole area our swing low. Right now, why is this a swing low? Well, it's the lowest point in which the trade went, right? Where it either broke structure or it took liquidity. And in this case, we went back, right? And we did take liquidity. We rejected off of a previous point, and we came back and we tapped another order block, right? However, before we took this sell side liquidity, we did get a retracement. So whenever we take this liquidity and then we get this retracement, that is when you want to really be looking for your entry on a fib, right? So if we're looking at this, usually for me personally, I fib from body to wick. That's just how I was taught. A lot of people do it from wick to wick, which is perfectly fine as well. However, I do it from body to wick just to kind of, for me, it's always worked a little bit better because your R&R is a little bit more disciplined. So then we end up getting our position from here all the way down. Now, out of all of these fib levels, why do you guys think that my fib is set up a little bit differently? A lot of people, a lot of mentors out there will tell you that you should be looking for the 61.8 or the 62 fib level, which would be somewhere around here, right? Why do you think they're going to be telling you to enter at such a position? Because it's a magic number, because it's this, because it's that. I've heard a lot of reasons why. However, when we're looking at the actual market and how it actually works, I want you guys to write this down in your notes, and I'm going to write this down on the side here. The market prefers extremes rather than shallow retracements. Now, this goes back and it pairs very nicely with our theory in terms of the PD array, right? Which is also something coined by ICT, right? A quick question from Sniper Gang. How do I know which time frame to use the fib on? You can use it on any time frame. Like I said, price is fractal. As long as you have a correct setup, right, which is taking liquidity, which is doing, filling in the criteria, and as long as price structure is actually holding that position, you are more than welcome to use that fib. Right? You're more than welcome to use it. So, yeah. So at that fib, right, you can use it whenever you'd like in whatever time frame you'd like. However, I really want you guys to focus on what I just wrote right here. The market prefers extremes rather than shallow retracements. Who can tell me why? Who can tell me why the market prefers extremes rather than shallow retracements? Or if you guys have heard this before. More money? Buy low, sell high. Okay. Greedy banks. Right. And this also fills back into our PD array, right, into premium and discount. Because if we think about it, right, if you guys aren't familiar with premium and discount, really all that premium and discount is a range of prices, right, that essentially price goes from one end to the other. And it's essentially saying that banks want to sell right at a premium price and they want to buy at a discounted price. Now, why would they do that? That's just kind of basic economics, right? Hedge funds don't think like us. We have to think with them, right? However, us as retail traders, well, not retail, as we want to follow institutional trading, but we technically are retail traders because we do not have that amount of money to compete with these big banks. So what are we going to do in this case? In this case, we want to think like the hedge funds, but we also want to understand why they think or why they maneuver price in such a way. Let's think about it this way. If banks were to buy, right, a lot of positions at a lower price, that would be a lot more beneficial to them, right? That would be a lot more beneficial to them than if they bought a lot of positions at a higher price. That's just kind of basic economics, right? That's just basic money management. Now, why would they want to sell from a higher position? Because of the simple fact that banks really like to take positions from a higher point. It'll get them more money, right? So let's put this back into perspective on the whiteboard, right? Let's go back to the whiteboard. I'm actually not going to use my phone to draw here. Oh, actually, quick question from Alpine. I've seen fibs drawn from base. I've seen fibs drawn base right towards the left peak. Okay. So this is a quick misunderstanding, Alpine. So it's the same thing, they just do it differently. So on MT4, I'm pretty sure you have to draw it from right to left. Meanwhile, on TradingView, you can do it from left to right. You can do it each way as long as you are retracing back into your 79%. Okay, as long as you're retracing back into higher numbers, that's completely fine, right? So let's go back to the whiteboard really quickly, and let's look at a PD array. And a PD array, all that really means is premium and discount. Okay, premium and discount, and we kind of have to go back over this because you guys have to understand why optimal trade entry is real. Why optimal trade entry works, and why it's so useful. Because a lot of people kind of sleep on it because they think like, oh, order blocks, oh, inefficiencies, oh, voids in price, stuff like that. That's all fine. But the simpler that you maintain your trading, the better. And this is something that will help you a lot in your trading. So as you guys know, right, we have the top of a range and we have the bottom of a range. So let's pretend that this is actual price, right? And let's say that price, touched here, it shot back up, mitigated. Oh, whatever price will do. Whatever price will do. There's a little bit weird of a graph, but either way, we're gonna stick with it, right? Now let's say that at 50% of this is known as the equilibrium. Now, who can tell me why this is equilibrium? Well, it's very simple, because this down here is discount, and this up here is premium, right? Very simple. Now, why do we classify these ranges as premium and discount? Very simply, because at premium prices, right, at premium prices up here, banks will sell, are more likely to sell, right? And in these discount prices, banks are a lot more likely to buy. Why? Prices are lower in discounted areas, and prices are higher from a premium position. So think about it if you were selling, say, coffee. If you were selling coffee, and you wanted to sell your coffee to get as much profit as you possibly could, you would sell it at a premium price. Now, why would you sell it at a premium price? Because then you're selling it at a higher price, and then you're getting a lot more money for each one of your products. Since hedge funds need to actually buy a contract and somebody else needs to buy that contract from them, or they have to sell that contract, right? And they have to sell that contract to somebody else. They have to either sell it at a very high price or they have to buy it at a very low price. So that way, no matter where the market goes, they'll most likely end up in profit because of the sheer amount of volume that they have, right? The sheer amount of volume that they have. So if we think about it this way, this right here, this line right here is known as equilibrium, right? This little line right here is known as equilibrium. And equilibrium is very important because equilibrium is the 50%, right? So it's the 50%. You guys can also mark that on and your notes as your fib, right? So if you guys are trying to look for market equilibrium, you guys should be looking for the 50%. Right now, what is the 50%? That marks the boundary between premium and discount. That marks the boundary between premium and discount. Now, why does this matter? Well, very simply because, as I stated before, the market prefers extremes. And if the market prefers extremes, we are more than likely going to go back into premium pricing to sell off, right? And we're more than likely also going to go back down to discount pricing to buy up again, as we see right here, right? As we see here, we tapped equilibrium, we retreated back into discounted price, and then from there we resumed the upward market into premium pricing. Now, once we return to premium pricing, we are more than likely going to sell off, right? That's just kind of understanding what a PD array is. Now, this is another one of our range finding tools. Now, why is this a range finding tool? Very simply because this tool helps you as a trader find a position where the market is more likely to buy or to sell. Does everybody understand what a PD array is and how to use it? Does everybody understand? Yes, yes, yes. Okay, perfect. If anybody has any questions, please make sure you guys speak up. I'd rather take a little bit longer for people, for people to get their questions answered rather than you having a question and you being stuck with it and then losing money over it. So please, if you guys have any questions, make sure you stop me and we can go over that question. All right, so now back to the charts. Let's go back to the charts. That's what we're here for. So if we look at NZDJPY from the perspective of when we took it yesterday, let's actually replay this because we took this trade live. So we can actually say that we took this trade live and that we're not hindsighting anything because we took this trade live. So there's no cheating here. So where would mark our PD array? So essentially we have our high, we have our low, right? We have our swing high and we have our swing low. When we fib it, we have our positioning, which means that our 50% or our equilibrium line, somebody else called it a fair value line. That's also what it's known in some circles. How ICT originally coined it was an equilibrium line. So I'm just going to call it how I know it. So when we have this equilibrium line, what is the actual optimal trade entry? And I'm going to go down here to kind of explain it to you guys. So whenever a lot of teachers, right, quote unquote, use the fib, they end up using it in a very, very weird way. So let me draw you guys up an example. Let's say we're trying to let's say we're trying to buy into a market, or sorry, to sell into a market, right? And we're doing this, right? We're doing that. So we have our swing high up here and we have our swing low down here. So how would we use our fib? Very simply, we go to our trading view, we select our fib, we select the top, right, the swing, we drag it all the way back down to the bottom of the swing, right?
Are you counting wicks there or the body?
So like I said earlier, me personally, I do it from body to wick. However, you can do it from wick to wick however you feel most comfortable. It really goes down to an experience thing, and it's something that you develop like your own taste for it. Me personally, I like body to wick. It tends to be a little bit more accurate, just a tiny bit more accurate. because price prefers extremes. So a lot of times with that wick, you'll end up, you know, getting a little bit deeper of a retracement. But me personally, I do from body to wick. You can do from wick to wick if you'd like. Yes. So how can we tell this is the end of the swing? Well, we can tell this is the end of the swing because it will start retracing and it'll go back above this equilibrium line. Now, what is this equilibrium line again? That is the threshold between our premium and our discount, right? That's the threshold. So once it passes that threshold, we'll be able to say, okay, we are we're going back up into premium pricing. So we can actually go ahead and say, all right, this premium pricing is going to be very important to us, right? Now, what is the difference that we're using a fib compared to other teachers, other gurus that would use a fib? Well, a lot of them will tell you to add the 61/8 level, right? And let's go ahead and add it. Let's go ahead and add it. You know what? Let's go ahead and add it. Me personally, I don't use this level. Why? Very simply, there is no real such thing as a magic retracement number. That's just as simple as it gets. It really has no mathematical value, right? It really has no technical value in the market. It may in math, right? But it not necessarily in the market. So just get rid of it. Don't really even think about it. The reason why I use the 50 is really only to find equilibrium. Now, this is where I tell you what levels you're going to need. The levels you were going to need are going to be the 0.886 and the 0.79. Now, which is the 0.79? The 0.79 is also known as the optimal trade entry. That is the fib level that you guys want to look at. So 0.79% is equal to the OTE, or the optimal trade entry, right? The optimal trade entry. Now, this right here, the 79%, is going to be kind of where you want to be looking at your your entries. If you want to be deciding whether or not you want to be looking at your entries and whether or not you actually like the move for what it is, right? At that point, that's when you kind of decide your move and you say, okay, well, am I going to take the 79 OTE entry, or am I going to hold off? Now, this is very interesting because this is a zone, not a line, right? And this zone is a zone because the other fib level, which is extremely important, is also known as the 0.886%. For me, I just call it a sniper line. You can call it whatever you'd like. I just kind of call it that because it's, you know, it's catchy. So I call it that, right? The 88.6 sniper line. Now, a lot of people will throw out that buzzword sniper line, but when you back test the accuracy of the 88.6 and the 79 optimal trade entry, you will be astounded to see how often price will react off of either one of the two if the move is valid. Okay, so I also use this bottom fib level right here. This bottom fib level called the 0.705. Now the 0.705 is kind of important because it's your alert line, and that alert line is something that will help you a lot. So this is the 0.705%, also known as the alert line. Now, why do I call it the alert line? Very simply, I call it the alert line because that line is very helpful to you, because a lot of times price, in the rare occasion that it doesn't reach the 79, it will usually reach the 705. And by that point, you can kind of start looking at it and say, okay, am I going to market execute? Am I going to let it keep going to the 79? And a lot of times you'll get a lot of reaction and you'll say, well, at that point, you're at least ready to take that trade. A lot of my student traders that I've personally trained, they end up using the 705 line as kind of like a get ready to enter type thing, because a lot of them may not like using limits, which is completely fine. Um, And if they want to enter manually, what they can do is they can use the 705 line as an alert on TradingView. So if I just right click here and I go to add alert on my 705 line, when price reaches that point, I can pull out my phone, and instead of using it as a limit, instead of using the 79 as a limit, what I can easily do is I can just check the 705 line and see whether or not it already blasted past my entry, and then my setup isn't valid, or whether or not it's actually holding at that position and it's showing some type of reaction. One thing that I very, very much don't like about how some other people teach or trade is that they wait for a ton of different confirmations. With smart money, it's a train of thought, right? Smart money is a train of thought, meaning that you as a trader must end up thinking like smart money, okay? And a lot of people use it as a buzzword, but you must be thinking of how the market has shown its hand at this point. How has the market shown its hand at this point? Very simply, the market has shown its hand because first, the fib line, right, has already taken liquidity, meaning it has either broken structure or it has created new structure, right? And also, at that point, price has already returned back into premium pricing or discount pricing if you just flip it for the bullish scenario, right? It has returned into either into either premium or discount pricing, whichever one of the two you're looking for, and you're already meeting that criteria. At that point, you should be a good enough and disciplined enough trader that you will just take the trade without any emotion or hesitation. Why? Because it's already filled your criteria of taking liquidity or forming structure, and it has already returned back into premium or discount pricing. And the chat is blowing up. Oh my goodness, I'm sorry. I didn't want to completely like ignore you guys. I apologize. Um, how do you find your range? So your range is very easy to find. It's simply from the top, right? So from the top of where the move originated. So this is actually very important for your notes. Your range starts where the move down first originates, right, in a bearish scenario, or up in a bullish scenario. Um, so it's where the move originates to where the move stops and the retracement begins. Okay, so it's from where the move originates all the way down to where the move ends and the retracement begins. Okay. Can I share my fib settings? Of course I can. Let me just go over this. Uh, what about the 71%? I've seen that price tends to hit that one a lot too. 71% is the same one as 705. Let's see. So 9 out of 10 when you use your fibs for optimal trade entry, the more confirmation. There should be other confirmations in the optimal trade entry, such as an order block, fair value gap, etc. Yes. So a lot of times what you will notice along in your studies with trading is that a lot of times within the 88.6 level, you will end up finding the entry to an order block or the 50% of an order block. It's very interesting because a lot of times you will end up finding something like this. And this is actually where I pulled back out the whiteboard because I want to show you guys something that you'll end up noticing a lot. And let me keep the chat open so that I can, oh, hold on. Let me stop sharing. Give me one moment. I'm trying to pull up my my whiteboard. Here we go. All right. So a lot of times what you'll end up seeing is you'll end up seeing an order block up here. And this is where the market will actually originate. Okay, this is where the market will actually originate. Now, if you guys don't know what order blocks are or how they work, I will explain them in a little bit. And I believe Mustafa did his class on order blocks yesterday. So you guys should know this, right? Now, now, whenever you guys are looking for this order block, right? And let's say the move originates from this point up here. Since the market originates from this move up here, it will have to end up having a end, right? So let's say price has come down to this point before, right? So this right here becomes our liquidity. Now let's say price ends up moving downward from this position. It ends up taking this liquidity, right? So it took that liquidity. So now this right here becomes a liquidity that has been taken, right? And then from there, it stops moving, starts consolidating, or however we want to look at it, right? And then it starts retracing upward. Now, when it starts retracing upward, right? When it starts retracing upward, what are we going to look for? What are the two criteria that we're looking for? There are two criteria. And Alpine just asked a question. I apologize. Sometimes I see 50% order blocks poked at several times. Does the order block get invalidated after the first retracement touch? No. The order block does not necessarily mean that it was invalidated after one retracement, two retracements. That is called mitigation and remitigation or reclaiming of a block, right? So that's kind of a little bit of an advanced concept, and really knowing how to distinguish a reclaimed block is a little bit more difficult. But most of the time, an order block will usually only get mitigated once, most of the time. If it gets mitigated twice or three times, a lot of times there's going to be a lot of buildup of liquidity underneath, meaning that price is going to shoot up or shoot down, depending on the side. And then from there, it'll start looking like liquidity. Perfect, Nick. It'll literally start looking like liquidity. So at that point, you want to be wary of price reacting off of a point above it, right? Off of a point above or below that order block, and then actually taking the liquidity below, because it just built its own liquidity. Okay, does that make sense? Alpine, are you sure that makes sense? Do you actually understand it? I want to make sure you completely understand it. Yeah? Okay. And I'll probably do a class or a podcast with the other guys from Empire, and we'll probably talk about mitigation, remitigation, and a little bit of some of the more advanced concepts that we want to save for later. But okay, so back to this example. We already have one of our criteria met here. What is the first criteria? Here we have the liquidity. So the liquidity taken is one of our criteria. The second liquidity, perfect, Francisco. We're looking to sell at a premium price where we want it to be at the optimal trade entry, right? So perfect. If we look at this and we just kind of eyeball it, we will see that our 50% line will be somewhere around there. Let's just kind of sketch that out there. Let's just say that this here ends up being our 50% line. So this is our 50%, which is also known as what?
Equilibrium.
Equilibrium. Perfect, right? So the equilibrium is going to be met. Now up here we have premium pricing. We have premium pricing, right? So we've just crossed over from discount pricing back into premium pricing. So that way we can also tell, okay, perfect, right? Okay, perfect. Now we've met two criteria. We've gone into the zone of liquidity, which has been taken. And then from there, we move back into a zone of premium pricing where price will actually move to take, to come back and remitigate this order block, or come back and kind of put two and two together, right? So when we start putting these two things together, we start to understand why the market moves in such a way. Because right here, we're mixing two concepts. We're mixing the 79 optimal trade entry, right? And we're mixing the order blocks, right? Because at that point, we are kind of understanding how the how market synergy ends up working out. So if, let's say, we were to fib it from here to here, right? So our two fib zones, let me actually do this in a different color. So our two fib zones from here, let me delete this. Oh, whoops. To up here. Right, so if we were to fib it, our 79 would be somewhere around this area, and our 88.6 would be somewhere around this area. And then our 1 would be at the very top, so, around here. Now, if this is going to be our kill zone, right? Or our kill zone, our golden zone. So this right here is where we really want to start looking at where price is going to react, right? Because if we see that price is reacting at that point, we can easily take an entry off of that position. We don't even need to wait for a reaction. We can just go ahead and take it because of the amount of accuracy that those fib levels really have, right? And that's kind of the most simple way to understand smart money. It's not a very conceptualized and professional that you'll make $1 million on just the 79 optimal trade entry, but it's something that will help you as a beginner to smart money start to see how the market moves. It helped me a lot when I was first learning. When I was first learning from from the big ones like ICT, I didn't quite understand what a liquidity void was. I didn't understand what crouching at an order block was. I didn't understand how an inefficiency worked or how magnets of price worked. The only thing that I knew is that I could pick up a fib, I could find a high and a low, and I could draw the retracement. And if it met certain criteria, I'd take the trade. That's kind of the simplicity of the 79. It's simple, it's effective, and it starts showing you where the market reacts. Because the more that you end up looking at this 79 optimal trade entry, you'll end up finding order blocks behind it. You'll end up finding inefficiencies, or you'll end up finding some type of form of structure, and you'll end up seeing and you'll have that oh moment. You'll say, oh, okay, I understand why I took this trade apart from the fib. Right. So when I was teaching people like Jay, or when I was teaching Mustafa, actually, he would always pull out the fib, and that would be his reason. And I'd always tell him, no, there's another reason behind that. And that's where he got so good at spotting order blocks, at spotting different trades that sometimes even I don't see. He just sees them because he practiced so much with his fib that just by looking at how the market moves and that pattern, he ended up seeing things that now he teaches you, but I may not have seen at that very moment. So that's something that's going to lead to your aha moment, right? It's going to be you looking at price, meeting criteria, and then from there, taking a trade once you've kind of bonded these little pieces of the puzzle together. Because you've already adapted a lot of institutional concepts into one move. So let's take account of it. You've just used premium and discount array, right? You use the equilibrium line. You've used liquidity, right? You've used an order block, and you used mitigation of an order block, and you've used the 79 optimal trade entry. That is 6 things of institutional trading that you just used, all by just taking a fib, finding a high and a low, meeting some criteria, drawing it, and taking a trade. That's what you've just done. And you should feel proud of it, because that is your first couple steps as a trader. That is your first couple steps as beginning into smart money. So if we were to go back to this example and actually see what's going on, we would end up seeing that price ends up going all the way back up, and then once it touches this position, it'll end up dropping, breaking structure, and coming back down into this position lower. So one thing that a lot of people are going to ask is, well, where's your stop loss? Well, here's very simply. If your entry is going to be at your 79% or at your 88.6%, whichever one, your stop loss will always be either at the 1.0 or at the 1.1 fib level. Okay. Now, this is just kind of you looking at the fib and trying to find your stop. You can also be a little bit smarter and look at structure. So if you see, like the end of an order block, or if you use market, yeah, perfect, Francisco. Can we use market structure as a stop loss? Yes. This is just kind of, like a little bit of a cheat sheet. Yes, you can use market structure as a stop loss. Use it, honestly. Use it as a stop loss. But if you want to be a little bit lazy, you can just use those levels as your stop loss. But yes, you should be getting into the habit of using market structure as your stop, because a lot of times when you use market structure as your stop loss, you will end up seeing smaller stop losses than if you just took a trade off a whim, or if you just took your stop loss and moved it all the way to the 1.0 or the 1.1. A lot of times, especially on larger time frames, you'll end up with a little bit larger stop losses, and that's okay. I feel like a lot of times here, especially in Empire, we've kind of glorified using smaller stops, which is perfectly fine. But remember that risk to reward is everything. You shouldn't be stuck with a 1 to 3 every single time, but you should be finding as much risk to reward as you possibly can. So if your stop loss is 50 pips, but if your take profit is 500, then you're fine. You're completely fine. But you should be getting into the habit of using market structure as your defining position, and not trying to squeeze or choke out a trade because your stop loss was too small. I used to fall into that trap a lot, and I'd used to try to call snipers with, a 2 pip stop. I'd get stopped out and I'd get frustrated. Well, I knew it was going to go in that direction, and 10 pips later it went in my direction, another 180 pips. But I wasn't there to catch it because my stop loss was too small. Okay, so that's actually a very, very good point that you just made, Francisco. You must use market structure as your stop loss. Don't get lazy. And I know I just told you guys that there's a little bit of a lazy way to do it, but don't get lazy. Don't get complacent. Just use market structure as a stop loss. Okay, use it as a stop loss. If you're not sure, then you can use the 1.1, 1.0. Okay, but don't get lazy. Alpine just commented, are the OBs valid only at the immediate left of structure, or could it also be beyond the structure further to the left? A lot of times, if structure is past that point, you want to be wary of it. Unless, so, okay, this is actually just got a little bit more complicated. So let's say that this, oh boy, how do I explain this? So let's say that this price right here, was like equal high, right? And this right here has already had another position here, so this becomes liquidity, right? And then there's an other order block up here. What's the obvious move of the market? Is going to take liquidity, is going to tap this order block, and then it'll shoot down, right? So if, for example, if we go back to this example right here, if this right here was an equal high that had liquidity above it, then yes, you would definitely be looking for a position behind it in which an actual order block or another position of price or another structure of price was actually positioned at, right? You wouldn't be looking at this if there's liquidity above it. So one of the biggest things of an order block that trips people up is that an order block must always not have liquidity above it. If it has liquidity above it in any form, fashion, or sense, it will get violated. It will get your stop loss hunted because price is attracted to that liquidity. So it's like trying to dangle a magnet on top of, a little metal piece and expecting it not to get pulled to that. It's gonna get pulled to that. So if there's liquidity above your order block, just paper trade it. Don't take it. You'll end up learning the difference out of experience later on. Okay. Now, how do I tell you this, saving you that time? Very simply, if you think there is liquidity above an order block, don't take the order block. That liquidity is going to get taken before that order block gets taken. That's just kind of the hierarchy of price. Liquidity is always going to be above everything. So do you guys remember my law a long time ago from the boot camps? Do you guys remember that? Liquidity is king? Literally, because liquidity will be above everything else. It will be above order blocks. It will be above liquidity voids. It will be above 79. It'll be above everything. Liquidity is king. So if liquidity is above an order block, don't take the order block. Oscar just commented, how can you fully confirm if the liquidity is captured? A lot of times an order block will be the top of a position, right? Or it'll be the bottom of a position, meaning that there is no liquidity there. So I hope I'm answering your question here, because the liquidity is going to be captured above an order block if there was already mitigation there, or if the order block itself is a mitigation. So for example, let's go to a new whiteboard here. Let's say that price makes a high, and then this right here becomes an order block. This right here is the mitigation of this high. So this right here is the mitigation of this high. So there is no liquidity up here. There is no liquidity here. Why? This already mitigated the other liquidity. So now if price falls from here, takes liquidity, right, and then comes back up back into discount pricing, into premium pricing, and it hits the 88.6, you can safely take that trade and it'll go in your direction because of the fact that this has already mitigated the top position. So if an order block is the mitigation to previous liquidity, you're perfectly fine. For that, could you just try to look at the bigger picture and see if there's no equal high at the order block? Yes. Yes, that's kind of what I tried to portray there. I think I did a pretty bad job of it, but yeah, exactly, Francisco. So you can look at a higher time frame and say, okay, is there an equal high at that position? If there is an equal high, most likely there's liquidity there. And because of that, you don't want to take that order block, or you want to be cautious of it. Can I draw an example of an order block with liquidity above it? Yes. So this was kind of the example right here. So like, let's say for example, right here, let's just kind of redraw all this because this is kind of bad. Let's say that this order block right here, you know, you say, okay, well, it took liquidity, it comes back up to premium pricing. Now, but if you look at you know, at previous numbers, you'll end up seeing that this right here is a range, and you'll see that it has already made previous highs. So this right here becomes liquidity. This right here becomes liquidity, right? So that there, so if this was considered an order block, you no longer want to consider that an order block because there's a magnet to price above it. I'm sorry, that is a horrible magnet, but there is a magnet to price above it. And because of that, price will most likely take that high, go up to another form of structure. Let's say there's another order block up here, and then it'll start moving its way back down after it's taken this liquidity. Does that make sense? Miami Mill? All right, cool. No problem. So you know it's mitigated when price reaches a market extreme. Yeah, yes, ish. So so you know that it's mitigated. What is mitigated? An order block or a previous high and low? So a previous high and low doesn't necessarily need to be mitigated because there's nothing there to mitigate. A previous high and low, you might mean an order block, right? That is at a previous high or low, will be mitigated if it reaches that market extreme. So an order block, for an order block to be mitigated, price must return to that position. It doesn't have to create equal highs, but a lot of times it has to reach at least close to that position. And that's kind of, you know, how an order block works. So if an order block is returned to, then price will mitigate it or remitigate it if you know it comes back another time. Does that make sense, eh? Okay, no problem. I think mitigation of the order block at the 50%. A lot of times, yeah. So a lot of times at the 50%, it usually lines up with the 79 or the 88.6. Yes. A lot of times the 79 or the 88.6 is where price ends up being mitigated. So let's actually look at some examples. So now that everybody knows this, I'm going to share how I use it. So let's say we go ahead and, well, actually I've already shown you guys how I use it, but let's say we took a trade, right? Let's say we took a trade and we've actually moved positions all the way up here, right? And then it takes this 88.6, then it moves all the way down. Your first take profit should always be your zero. Your first take profit should always be your zero. As you guys can tell, the zero is right here. So this should always be your first take profit. Now, beyond it, you can see a couple more extensions. These are called Fib extensions. And all credit of this goes to my mentor, or, you know, the person who taught me a lot of what I know, not all, but a lot of what I know. And he taught me how to use these extensions in a very, very cool way. So essentially, each one of these will serve as extended TPs. The two will usually end up being, you know, the final TP. However, each one of these has kind of corresponding values. So if we hit, you know, the 88.6, then a lot of times we'll end up hitting the negative 61.8. Right? If we ended up hitting the 79, a lot of times we'll hit, you know, the negative 41.4. Right? So each one of these kind of corresponds. You guys don't have to learn this tonight, but it's something that you guys will end up seeing, you know, at a different stage in your trading. So your final TP will usually be your 2, right? And your external TPs or your further TPs will be these extensions. Those are the ones that you guys want to look for. So the Fib settings that I'm going to share with you guys today, you guys are more than welcome to copy them if you'd like. These are these ones here. Go ahead and screenshot them, copy them, however you like. Does everybody have them? Yes, sir. Everybody has them. And if somebody could screenshot this and put it in the chat as well. Okay. All right. Does everybody have it as we need it? Okay. So if you enter at the 88.6, your second TP would be at the negative 41.4. Yeah. So let me kind of explain that one more time. So if you entered at the 88.6, your TP would be at the your TP2 would be at the negative 41.4. If you got in at the 705, your second TP would be at the negative 207, right? If you entered at the 79, your oh sorry. So if you entered at the 88.6, your second TP would be at the negative 61.8. If you entered at the 79, second TP would be at the negative 41.4. And then if you entered at the 705, your second TP would be at the negative 207. Oh, sorry, 0.27. Does that make sense? Everybody understand that? I hope everybody understands that. So we're gonna go ahead and keep going. Let's look at some examples that the market actually has put out for us. So let's go ahead and remove all these drawings. Then let's go back to NZD JPY as we were. So as you guys can see here, we cleared liquidity, right? We cleared this liquidity back here, so we meet that criteria. Now we can go ahead and drop it from the first position to the second, right? So from the low to the high. And then from there, we know that our first take profit, so I'm going to put it at the body because usually that's where I put it. Our first take profit would be right there. So where would be our entry in this case? Where do we see liquidity line up? For me, liquidity lines up at two places. So liquidity would line up either at this inefficiency right here, or it would line up at the 79, right? Because we have this little bit of liquidity there. So my position would be somewhat like this. So this short position would be at the 79, right? And then my stop loss would be actually a little bit above the 88.6. So I'd put it at around the 1, right? So that's a 20 pip stop. That's not bad. And then we would actually take our first take profit at the 0 at 70 pips. Now, this isn't some glorious 2 pip stop, right? Because it's a simple way to do it. As I'm telling you guys, start using the 79% retracement as soon as you possibly can in your trading, and you will see consistent results. Now, I'm not using any advanced, refined, smart money, nothing. I'm not using anything. The reason for that is because I'm trying to keep it simple for everybody that's beginning or everybody that wants to refine their Fib practice, okay? Because the more you get this down, the better. Okay, the more you get this down, the better. So I'm not using anything fancy. I'm just spotting where I'm seeing, my position. I'm putting out my stop, and I'm putting my take profit. That's all I'm doing. Okay, that's all I'm doing. Let's actually put this right here, and let's watch the trade rock. Let's actually slow down price a little bit. So we get wicked in at the 79. We drop 35 pips. We drop another 50. We almost hit our TP. And there we go. I think our TP got hit there. Yeah, our TP got hit there. There we go. So at that point, we're out of that trade. And then it starts reversing again, right? So that perfect exit at the 0, right? At the 0, you have two options. And this goes into trade management, right? This goes into trade management. At the 0, you can do one of two things. At the 0, you can either close half of your lot sizes or you can fully scale out. Whichever one you want, you can do. Whichever one you want, you can do. You can either scale out, right, meaning you take all of your profit, or you can completely, you can close half of your lot sizes. Now, what does half of your lot sizes mean? If you go to your MT4 and you go to an active order and then you click close, right? But you don't close everything out yet. You just click close. It'll take you to a menu where it says select how many lots you want to close. A lot of times people would just say like close with profit or close with loss. I don't want you to do that. I want you to look up and it'll actually let you select how many lots you want to close. So let's say you have a 1.0 open, right? And then you say you want to close 50 lots. You're closing 50 lots. So you're closing half of your profit. So at the 0, you can easily close and secure half of your profit back into your account, and then you can let the rest run. So that's essentially how you close partials, right? Perfect. So does everybody understand how to use the 79 optimal trade entry and how to combine it with other things like premium and discount and order blocks? So Sniper again just said, if you scale down to a smaller time frame, can you get a smaller stop loss? Yes, you can. However, as I said earlier, I'm not overcomplicating anything. I'm not going into lower time frames. I'm not using anything fancy. I'm just using this. Okay, and it's not just one isolated incident that I can tell. You can use it in any time frame because it comes up very much. It comes up a lot in the market. It comes up a lot in the market. And whenever you get stopped out, a lot of times you create liquidity. Like for example, right here, you more than likely were stopped out here. More than likely were stopped out, or barely miss you stop. But at that point, you created liquidity. So once that move played out, you know that this position was going to take this liquidity at some point, and look what happened. It violently took all of this buy side liquidity. So either way, you know that this works. Any preferred time frame to the simple approach? No, I suggest you don't scalp with it. A lot of people try to scalp with it and they're like, oh, why isn't this working? Because smart money is not scalping. If you're a smart money trader, you should not be scalping. Okay, you should not. There's no need to. There's absolutely no need to. And if you're thinking, oh, well, why not? Because no, simply no. Stop. There is no reason for you to be scalping. Okay, no reason. Because you have so many positions that you can take advantage of in the market. Why would you be scalping? There's no reason for you to. Here's one good example. So gold is a little bit more risky because you're using it on higher time frames. However, if you're looking at this from a very simple 79% retracement position, you took sell side liquidity. You took sell side liquidity, right? Your sell position is there. Your stop loss is at a previous high, which is a pretty big stop loss if you're looking at it from the 2-hour. However, your target's going to be at the at the 0. Later that gets tapped. If you wanted to use structure as your positioning, then your position at the 79 would be at the -414. And as you guys can see, your take profit at the -414 ends up getting tapped to almost to the pip. So you're using that inverse correlation, right, of the -79, of the 79% to the -414. And that take profit ends up getting taken. So in this position, you're not having extreme risk reward because I'm not using anything, extravagant, anything else in smart money. I'm just using this alone. I want to hammer that in. It's not that, I'm teaching you to use this every single time. I'm teaching you a very simple approach to the market, which is institutional and which will help you get a better eye for the market. Because if you would have looked at this, from a smart money perspective, you could have realized that, there was an order block here and then you would have had a stop loss right up there and you would have had an extreme risk reward, right? But that isn't necessary with this because this it's a little bit more lenient with your stop losses, but it's also a lot easier for you to understand while you're learning, if that makes sense. So I hope this class has been helpful to you guys. Do you guys have any questions that you guys may want to ask before we go ahead and end the class? What tips do I have for backtesting? Tips for backtesting. Backtesting should not be something that you use and you start saying like, oh, well, I would have done this or I would have done that. No, observe. What you have to be looking for in backtesting is observe and ask why. Why did the market move back up here? Why did the market violate, all of this buy side liquidity? Why did the market move in such a way this way? Why did the market redistribute? So like, what do I see here? Well, I see redistribution. Well, a lot of people bought at this position, but I see a lot of liquidity below. So why would I have not have bought here? Well, then you start talking to yourself and you start saying, well, price reacted in this way. It continued in this position. It created a lot of sell side liquidity. It retraced back to a previous order block, and then it took that liquidity. It never showed any bullish indication of filling this void. A lot of people were trying to buy into it, of course. However, they were not successful. Why were they not successful? Very simply because of the fact that they had so much sell-side liquidity here that there was nothing to sell, there was nothing to buy back into. They needed to take that sell-side liquidity. So for backtesting, pick whatever pair you'd like, go back a while and really just observe price. So if you start looking at this, you can start saying, okay, well, price reacted back here. It reacted to 50% of the inefficiency of the inefficient candle. Cool, came back, took liquidity. This could have been an 88.6 entry all the way back down to the zero. And then from there, it reacted off of 50% of the order block. So this could, so how would I have played this? Well, if I would have known that this position here was, still the high, oh, whoops. And I'm looking at this here, right? What could I have done? Very simply, I could have done, okay, well, let me look at my, at my 79 or my 88.6. Let's say I would have taken it at the 79 and my stop loss would have been at the 1. Ignore the pip count. Just, you're looking at what you're looking at right now. And you would have said, well, I would have seen this order block, so I would have targeted 50% of the order block. And then from there, you would have taken that take profit as much as you would have liked. So however you wanna backtest is really up to you. However, how I personally backtest is just very simply I observe price. So I look, okay, this happened. So I use the replay tool and you start looking at how price reacted. And you say, okay, well, price reacted this way, see 50% of an order block, keep that in mind. Price touches it, I scale out. Okay, let's go. Continuing on bullish, I would have probably bought that, right? I would have bought that instead of, sold this. I would have probably bought this. Then, just going back up. Okay, perfect. Price comes back down, breaks structure. This could have easily become a 79 entry, right? All the way back down. Because look, if we look at it, so me from body to wick, but oh, this was actually a 705 entry, which is still perfectly fine, but it would have touched your alert instead of your actual entry at the 79. So you would have missed this by a couple pips, but that's perfectly fine. And then it would have gone all the way down. And why is that fine? Well, it's fine because you had the right idea. And the more that you have the right idea, the better, right? So we have this position which went all the way back, all the way down. It retraced again, which you could have taken another retracement off of. It retraced here again, right? So it's really all about observing price and learning how it moves. That's how you backtest, okay? Sorry, somebody else had a question. Okay, so I have a couple questions here. It said, can you explain why you marked the liquidity $ where you did? I'm not sure of what pair you're talking about. Can you show a buy? Yeah, sure. I just need to find an example. I don't have one on me. So when you did the gold example to the left, you would fib to catch that initial drop. Hold on. I think I get what you're saying. You're saying this? Like if you would have fibbed this, you could have. I just wouldn't have liked this entry because it isn't going into discount pricing very well. Now, if you were using all of your smart money repertoire, you would have realized that this inefficiency got filled 50% and they got taken down. But since you're just using a very simple position, then you're not going to be using everything that you know. So the magnet strength is from liquidity, inefficiency, then the order blocks. So the magnet strength is just like what pulls price. A lot of times that is voids, that is liquidity. So liquidity is what is the magnet, right? So liquidity is the magnet. Liquidity voids essentially tell you that price has been delivered unfairly to all participants in the market by the market makers. So they need to come back and they need to fill in fair options for all of the market participants. That's really what a void is. It's like this, right? This is a void, and it comes back up and it fills that void. Can you pinpoint what you consider structure? If it built all oh my goodness, so many questions. Can I mention the TPs again? Yes. Give me one moment. Can you pinpoint what you consider structure? Is it all built up in candle or where price consolidates? Okay, so let's go back to the NZD-JPY trade, right? So what do you mean by structure? So when you say, can you pinpoint what you consider structure? Structure is this right here. So it drops below, it collects liquidity, right? So it drops below this liquidity or it mitigates this, right? And then here, this is the origin of the move, right? This is the origin of the move. This is the end of the move and the beginning of a retracement. Now, when this is the origin of the move and this is the beginning of the retracement, you can easily see that there was no higher high made. Since there was no higher high made, we can tell, right? And since it, first off, it never made a higher high. And second off, it came back and filled liquidity. We can kind of tell that bearish structure is shifting. So at that point, we can easily say, okay, well, this piece of structure just became bearish because it held this position. Right now, once it's actually held this position, we can say, all right, now we can fib from here to down here because this is considered structure. Does that make sense? I hope that makes sense.
Yeah, thank you.
Thank you, Mel. I appreciate you. So somebody was asking if I could show a buy. I'm not sure. I don't have an example of a buy on standby, but I can try to find one. Let me think. What pairs have been bullish so far? Let me see if I can find any. I'm not sure if I can, but I will try to. So actually this is a good example. So right here, it creates a channel. There's a lot of liquidity underneath, right? And then if you would have fibbed any of these, you would have gotten a buy right off of the 88.6. I don't particularly like how the majors are moving right now. So I'm really just staying away from the majors. Literally, how you get a buy on these is the exact same way you would have gotten a sell. You just flip it around. So this is actually a good example of a buy. So from here, I'd take it from body to wick. So from body to wick, right? From body to wick. And then I would have, because of the volatility of GU, I'll most likely put my entry between the 79 and the 88.6, or I'll just straight up put it in the 88.6 because that's also a really good entry. So let's say you would have taken this, right? And you would have taken this at the 1 because that was a better stop. Your first take profit is at the 0 at almost 200 pips, right? But let's think about the criteria. So the criteria is very simple. You see how price broke structure here, meaning it took all of this buy side liquidity? it took all of this buy side liquidity and it created its range. So here's the premium, here's the discount. Now in the middle, where's the equilibrium? Right around here. Now because of that equilibrium, it returns back into discount pricing. It returns once, it returns twice, right? And on the second position, you could have easily gotten another entry because of that remitigation of this inefficiency, right? And from there, it would have shot all the way up. Now, since you would have gotten your entry at the 88.6, or at least your optimal entry would have been at the 88.6, your optimal trade profit would have been at the negative 61.8. And as you can see later on in the process, your optimal trade take profit was also taken at 341 pips at the negative 61.8 because your optimal entry for this trade was at the 88.6. Right? Does that make sense for the buy? It still would have retained almost a risk reward of about 7, but you know, it's not the glorified, refined, market structure that we teach. However, this is an easy way for you guys to kind of start learning that market structure, because with this range finder, you can easily look down at the 79.88.6 and you could have said, okay, well, what mitigated here or what remitigated here? So at this remitigation, you could have gotten a very, very low drawdown entry at the 50% of this wick. Right, but that's more advanced, right? Because on lower time frames, that would have been an easy order block, But you would have only seen that if you understood lower time frame structure, right? Now, with that lower time frame structure, it's a lot harder to understand, right? But if you had this, 79% fib retracement on your repertoire, easily you'd end up looking at these things and you'll end up finding them naturally, but you'll also end up making money in the process, if that makes sense. So I hope this helped you guys. Does anybody have any closing questions that they'd like to ask? What time frame would I not use this? The 1 minute. No, I'm just kidding. You can use it on any time frame as long as you're responsible. Use it at any time frame as long as you're responsible and you're being smart with it. Okay. If you guys want another video that speaks on this same topic, I'm gonna go get it for you guys. It is the HFX how to trade it with higher time frame structure and the absolute guide to complex time frame analysis. So actually, let me get both of them for you. So let me drop them in the chat. So there's this YouTube video and then this YouTube video. Both of them are from Empire. Both of them are from me. And you can watch my previous work there. I just sent both videos there. Make sure you guys share it and you guys take advantage of those. All right, guys. Thank you guys so much for being here. I appreciate your time and effort. And I'll see you guys out there on the market. Make sure you guys are awake for London if you guys are going to trade London tonight. I most likely am because I'm going to be up thanks to college. But yeah, I appreciate you guys. Take care.